This is video number 4, Introduction to Options course. This time we're going to continue our discussion of covered call writing. And in the video I'll explain why I'm devoting so much time to this simple and single strategy. But before continuing, I'd like to occasionally throw in some additional information about options trading that I haven't set aside to put in one particular place. This is just adding to your education one step at a time. We've talked about exercise and assignment of options. And the very basic concept of an option is that the owner has the right, but not the obligation, to exercise. Yet, when expiration comes around, your right to exercise has been abrogated. They take it away from you. There is a procedure called automatic exercise. If you own an option that is in the money by 1 penny or more, it is automatically exercised for you unless you take specific steps to prevent that from happening. Now that's, to me, a breach of contract. I don't know why someone isn't suing the exchanges over this, but they are making you exercise when you might not want to do that. Now, why do I think they did that? To me, I think it's because the brokers charge you an assignment fee. And then for most people who don't want to have the stock that they just were forced to buy, they get to sell it out, and it's another commission for the brokers. I really think this is, I don't want to be paranoid, but I really think that this is a scheme to get you to pay more in commissions. And I think that's a shame. So I mention this every chance I get. But in a practical sense, you must be aware of the automatic exercise situation. And it works like this. If you own, say, a call option to buy a given stock at a strike price of 30, if the stock finishes, by that I mean closes on the last day of trading prior to expiration, at $30 or less, the option expires worthless. You may, if you want, tell your broker right after the close on that Friday, hey, please do exercise this option. You might have a reason for doing that. I can't imagine why you would, but you're allowed to do it. But here's the ticker. Here's the tricky part. If the stock finishes at $30.01 or higher, that call option is automatically exercised and turned into stock. Now, can you imagine if you're a small trader and you own 2 call options, and your broker exercises them for you, you now own 200 shares of stock, probably paid a $15 fee to buy that stock. Maybe you can't even meet the margin call and are forced to sell it, but even if you can meet the margin call, you probably don't want it. There's no reason why you'd want this stock, so you sell it. Another commission, $15, or again, your broker's individual charge more or less. It's just all that to save you $2. If the option, the option was worth a penny or $1 a piece, and so they cost you $30 in commissions to save you $2, and they think that's doing you a service. So you have to know this: if you own an option that is getting close to being in the money, and it's expiration Friday, you must either sell it, or, if it finishes in the money, be willing to exercise it, or notify your broker shortly after the close that you want to submit a do not exercise notice. And that when you tell them you do not want to exercise, that will relieve you of the obligation to exercise. Remember, you never had an obligation, but suddenly at expiration you have one. So, if you don't know how to do a do not exercise, and there's no reason why any of you should, I would call your broker and ask, in case I have to do that, what's the procedure? And I would write it down and make sure you have it. But it's easier just to pay attention, and if you own options, make sure you sell them. Now, I understand that if the stock is $30.01, nobody will be willing to buy them, and you will be unable to sell them. So you are going to have to eventually face this situation, unless you sell the option earlier in the day and don't hold it to the end. In that case, you're giving up your profit potential, but you can't have everything. This automatic exercise convenient for the brokers, it's convenient for the back offices, it's convenient for the options clearing corporation, and it makes a lot of sense. But it's unfair to us, the individual traders, and especially to those who trade small account sizes, because then the commissions are far more value than the money that they're saving you by not allowing your options to expire worthless. So do know that calls and puts that finish in the money by a penny or more are automatically exercised, and there is something you can do about it. That do not exercise notice. Okay, it's time to continue our conversation on covered calls. I have other things to tell you, and I'll be back with those after the covered call video. Let's continue our conversation on covered call writing. We're going to look at choosing which option to sell. We've already taken a close look at the front month options, or the Junes. This time, I want to look at the rest of the option chain for this stock. But before we do that, I want to add a couple of words to your vocabulary. We already know the word premium. The premium is the price at which the transaction is made when you buy or sell an option. The buyer pays the premium to the seller. That's the cash price of the option. The premium is composed of two parts. There's an intrinsic value, which is sometimes zero, and there is a time value. Add them together and you get the premium. The definition of the intrinsic value is the amount by which the option is in the money. The time value is the remainder of the premium that is not intrinsic value. And we'll take a closer look at intrinsic value as we go down the slides. But it's the amount by which the option is in the money, if that definition makes sense to you. But I'll show you examples. We're looking at a stock OFRP priced at 57. The volatility is estimated to be 35, and it pays no dividend. We've looked at the June options, and here are the July options, 49 days to go, from $7.60 down to 15 cents. If we want to sell July 50 calls, we can collect $760 for each. The July 50 call is in the money by $7. It has an intrinsic value of $7. How do we know that? The stock price is 57. The strike price of the call option is $50. The stock price is $7 higher than the strike price for a call option, and that is the intrinsic value. It's the amount by which it's in the money. It's in the money by $7. It has an intrinsic value of $7. Those are interchangeable terms. So because the price of the option or the premium is $7.60, that's $60. The part of the premium that is not intrinsic value is time value. And the reason why that's important to know is that time value. That's what you're aiming for when you write a covered call. That is your maximum profit when you sell an option that is already in the money. And that would be an option, call option, that already has an intrinsic value. So your profit here, $60 at expiration. And you get that because when expiration arrives in July, in 49 days or 7 weeks, you get $5,000 when you sell your stock at 50, and you get $760 now, total $5,760. You paid $5,700. What's left is $60 less commissions. It's a lot of downside protections. It is a really nice, safe play. It's not a lot of profit, though, so this isn't for most traders. In fact, the only people who I think would be interested in doing this is a very conservative investor who does not like the current low returns on certificates of deposit or treasury bills and would rather try to earn a little bit more, would try to earn about 1% in these 7 weeks, would try to earn extra and take the risk that the stock doesn't tumble below 50. If he's really conservative or she is really conservative, then this may not be safe enough. So this doesn't appeal to very many players, but it could appeal to the very conservative trader who's not happy with bank returns. If you sell the July 55 call, you would collect $400 for each. The stock is 57. The strike price is 55. The stock price is above the strike price by $2. This option has an intrinsic value of $2. It's in the money by $2, and thus the premium on this option, subtract $2 from $4, is $2. And $2 is the maximum profit. And here it is again, $2 per share, or $200 is the maximum profit. And we can get that the same way we determined it when we looked at the June options. If we sell stock at $55 at expiration, and obviously that assumes the stock stays that high, you get $5,500 then. You get $4 now, that's $59. You sold at $57, so your profit is $2 per share. And you have pretty decent downside protection. You won't lose anything if the stock drops $4 down to $53, and you'll be able to get your maximum profit of $200 if the stock doesn't drop more than $2 and stays above $55. So this depends on how you look at it, but I will tell you from my experience, this is a nice return. 3.5% in 49 days, 29% annualized. That's a very good return. Now, some people are greedy and don't consider this anywhere near enough when trading options. I think that's foolish, but if you like this strategy, this is certainly a very attractive return. And to do this, you basically have to be not bearish on this stock, OFRP. You have to be willing to buy the stock, hold the stock for 49 days, and believe that it will stay above 55. And if you do all of that, and it comes out the way you want, you'll earn your $200 and your 29% annualized return. When I say you have to hold the position all the way through expiration, I mean you have to do that to earn this profit, to be assigned an exercise notice, for the profit to be $200, but you don't ever have to hold any position any longer than you want. You can exit this trade early and accept a smaller profit, or if you change your mind and decide that you don't want to own this stock any longer, you can turn around and exit the trade. You sell your stock and you buy the call, and you might have a profit or you might have a loss depending on when you do that. So like I said, I just want to repeat, when I say you have to hold it, I don't mean you must hold it. I mean, you have to hold it to get these conditions, the $200 profit. But there's no requirement to hold positions all the way through expiration. That's something I want to get in your heads right now, because a lot of traders start off by believing that they must hold a position all the way, and that gives them very bad risk management skills, something that we want to discuss in great detail throughout this course, but not yet. Now, if you're bullish on the stock, anyone who believes the stock is moving higher can sell the July 60 call instead. Now, you only get $175 for the option, and you only have 1 3/4 points of downside protection. And so you are giving up $225. You collect less premium, but you have a chance to make a higher profit. If you buy the stock at 57 and eventually sell it at 60, you make $300, plus you're collecting $1.75 in premium for $475 worth of profit. When you sold the 55 call, your profit potential was only $200. So if you're bullish and you want to take the chance, because that's the point of the risk. If you take the risk that the stock doesn't decline more than this, so that you still don't lose, and if you believe in being bullish and believe the stock can go higher, and you want to take that chance, less protection, more profit, you can sell the 60 call and take in some cash and give yourself a chance to make more money, $475, if you believe the stock is going higher. If you want to be more conservative, it makes a lot of sense to just sell the 55 call and take the $200. I hope you get that difference, because that's going to be your decision again and again. Do I want more protection or more profit potential? You can't have both at the same time. That's how you have to make your choices. Which one is more appealing? Now, when it comes to selling the 65 call, and pretty much the same for the 70 call, the premium is small. These options are out of the money, as was the 60. When they're out of the money, that means the strike price is higher than the stock price. They have zero intrinsic value, so the full premium is the time value of the option. $1.75 was the time value. Same here. $60 is the time value. There is no intrinsic value because this call option is out of the money. Who might want to do this trade? Well, $60 is not very much, but if you're a long-term investor, you want this stock, you intend to keep this stock in your portfolio, you're not concerned with whether it moves higher or lower, you believe this is say, the Apple of the future, or IBM of decades ago, you believe this is a big stock and you want to hold on to it, you can sell this call, collect the $60, and you consider it as a dividend. Remember, it's not taxed as a dividend, it's taxed as a short-term capital gain. You can pretend it's a dividend if you want to do that. For this trader, there's a little bit of risk, because for most of us, when we write a covered call, we want to be assigned an exercise notice. That's a way to get a very big profit, or the biggest profit that the trade allows. But the trader who wants to hold on for the long term doesn't really want to sell it at 65. So for him, there's a little risk in doing that. So you may not find, that trader may not believe $60 is sufficient, and this may not be a good trade. I don't recommend it. This doesn't appeal to me, but I would have no objection to anyone collecting the $60 if they intend to hold the stock that long. The July 70 calls is similar, but at $15, I believe that's too small. Sure, you can make $1,300 if the stock runs above 70, but that is pretty unlikely, and I think $15 is too little, and I would not make this trade. And I think pretty much no one would. July summary. As with June, the choices that are attractive to most people are between the July 55 and the July 60. Remember, this had $2 of potential profit, that 29% annualized, and this had a higher, the July 60s had a higher potential profit, but that requires the stock to move up and get above $60 per share. What I wanted to point out this time, that was really not true for June, is that it's reasonable for a minority of traders to be willing to sell the 50 or 65 calls. There are a certain subset of traders who would find that to be attractive, but I doubt that anyone here would, because those are very conservative choices. And I have no objection to conservative. I teach conservative. I think that's good. I believe these are just a bit too conservative. The next thing we want to do is look at the September calls. 112 days in the future. How these months are selected is not important right now, but not all options trade the same months at the same time, and there is a way to separate them into different groups. If we look at the September 60 calls, this time the premium is $8.60. Now again, of course, it has an intrinsic value of $7. The strike price is 50, so the intrinsic value does not change when the expiration date changes, because it's the 50 strike is still in the money by $7. So the time premium changes. In this case, the time premium is $160, and the stock can decline $8.60 before you lose any money. So this return is at least a sum of money that's not close to zero. You do have to hold it almost 4 months. But if you're conservative enough to like 3.3% in this time period, which adds up to 8.2% annualized, then this works for you. It's better than a CD, it's better than bonds, and it only has the risk of the stock heading down towards 50. And below 50, you can start to lose money. Actually, it has to drop almost $9 before you lose, but you're not going to be happy if you don't make your $160. So this is for some conservative investors. September 55 calls. This time you collect $540. If you remember, for July, it was $400. And we went from 49 to 112 days. We more than doubled the amount of time, from 49 to 112, but the option price did not come anywhere near doubling. It went from 4 to 540. So as time is added to the price of an option, the value of the option increases, but it is not linear. That is, one extra day does not add the same as any other extra day. The further out you go, the less and less is the increase in the price of an option. To say that another way, the more time, as you increase the time remaining in the lifetime of an option, the rate at which the extra time value is added decreases. This is for a patient investor, because it's almost 4 months, but it's the same thing. You're not bearish, you're not overly aggressive, you're looking for the stock to stay above 55 or at least close to 55, and this time the return on investment, ROI, return on investment, is 21% annualized. Again, very attractive, and what makes this better than 29% annualized for some traders is that, if you're busy, if you have a job, if you look at your options maybe once a week just to see where your stocks are, but don't have time to trade and want to trade less often, it might be worthwhile to take 21% annualized rather than 29% annualized. Again, each of those is idealized. You don't necessarily earn that. To give you less work to do. So you can spend less time on your options. I don't mean less time and never looking at it. I mean less trading time, less preparing for a new trade, less of time entering orders. If you're working full time, you may not find it easy to enter the orders, although I believe that you can do that. You work on the weekends and you work at nights and you enter your order in the morning, always a limit order, never a market order. So that's the reason that's the person who would like this. Someone who doesn't want to trade as frequently, and you do save a little bit in commissions. And if you're trading very small numbers of options, like just 1 or 2 contracts, commissions can become significant. And actually, after commissions, this 21% annualized can turn out to be more than the 29% because when you trade so much less frequently that the commissions make the difference. When you trade these options, you'll see that they start to form a pattern. Longer-term options offer more protection because the premium is higher, the time premium is higher, lower annualized returns. We only looked at one example, but that's true pretty much across the board and all the time. And there's less trading, less work, and lower commissions. So in our example, for looking at the 55 calls, the June was a 1.9% return in 21 days, which was 33% annualized. And the July offered 29, and the September offered 21, all not counting commissions. So this is something that you should be aware of because it's constant. As you go out further in time, your annualized return, and although I didn't mention it, an annualized return merely means if you can make 1.9% every 21 days, then you'll make 33% in a year. And if you want to check the arithmetic, what I did is I multiplied this by 360, not 365. I multiplied it by 360 and divided by 21. I multiplied this by 360 and divided by 49. To get the annualized return. If you want to use 365, that's fine. These numbers are not written in stone. You can't have a situation where 32.5% is not good enough, but 33 is. I mean, these are ideas of approximation, and you like the target profit, or you don't like the target profit. And if you do like the target profit, then much more important is, do you like the risk that you see? How does the risk of this position appeal to you? If you like the profit potential and you like the risk that you see, then this becomes a very attractive trade. And that's a big part of how we determine risk and how we manage our risk, is we have to be satisfied in our minds that both the profit and loss potential are okay. And if they change during the course of holding a position, then maybe we have to change whether we continue to own the position. Again, more on that later. I just want to introduce the concept to your mind. Continuing in September, the 60 calls are 320. They're out of the money, so this is all time premium. There is no intrinsic value. The maximum profit is $3 from selling the stock, $3.20 from selling the option, $6.20, and you have $3.20 in protection. The stock can drop $3.20 or $53.80, and you have a break-even point. Anything above $53.80 and you haven't lost any money. Well, this is for the patient investor, just like was the September 55 call. This time, you have to be somewhat bullish. There's no sense taking 320 instead of 540 if you're not bullish. If you don't expect that stock to go higher, giving you the chance to make that extra profit, $5 extra profit by selling at 60 instead of 55. If you don't think that you can make that 5 points in profit, or almost all of that 5 points in profit, then there's no sense in taking 220 less in the prices of the options. This is the more conservative play. You earn less, but you have more downside protection. More conservative. This is the more aggressive play, but you want to be a little bit bullish to make this play. And this is also an attractive play that would grab the attention of many beginning traders and experienced traders as well. This is certainly a very reasonable call to write if you're willing to go out to September. Not everybody is willing to do that. The September 65 calls now at least have some value. And the same thing with the 70s. They're not near zero anymore. Sure, your maximum sale price is all the way up to 65 and you can make a big profit, but you don't have a lot of downside protection, and you have to hold it for almost 4 months. So this is for the impatient investor who wants to own this stock, the long-term holder, as I like to say, and this is essentially a dividend. However, if you really want to own this stock, there is a chance, not a great chance, but a reasonable possibility that the stock will be $8 higher in September, and someone may buy your stock at 65 when you really don't want to sell it. So if you're that patient investor who really doesn't want to sell the stock, you might want to sell the July 65 instead, or choose the September 70. The September 70 is for the patient investor who does not need protection, likes the stock, wants to own the stock, is willing to take protection of less than the downside, and consider the $90 as a dividend, assuming there's very little chance that the stock will be bought at $70 by the time September comes around. So again, we're looking at the similar patterns each time we trade a new expiration month. Before moving on, I want to make one point, something I've been glossing over up till now. When we look at this slide, we're looking at the September 70 collecting $90. I have here a maximum sale price. Sure, sell the stock at 70, make $1,300, buy 57, sell 70, plus make $90, maximum $1,390. There's no need to sell the 70 call. I don't want to give you the impression that if you sell the 70 call, you have a chance to make $1,390. If you don't sell the call, you have a possibility for an unlimited gain. Now, I think that's pretty obvious, but I don't want to take any chances of confusing anyone by having said the wrong thing. This number, maximum sale price, maximum profit potential, that's very important when you're looking at in-the-money options, such as the 50 and 55, at-the-money options, well, we don't have any in this example, and slightly out of the money. The stock has a reasonable chance to get to 60, especially when we're looking at a little bit longer time frames like this September with 112 days compared to just the June 21 day. So I want you to understand that this 1390 is not important here. It's just written down as a number for comparison purposes. This number is very important when looking at slightly out of the monies and in the monies and at the monies. Okay? So I guess that's really the point. I don't want you to get confused. I'm always afraid of saying something that will have a negative impact, and that's why I try to take the extra time to clarify and be sure that no one is left with any misconceptions. But please, if anything I said is not clear, that's what the comment section is for. Put up a comment and I'll get to you as quickly as I can. Those of you who are taking these courses are very important to me. I want to make sure you get this. This is my job, my responsibility. So please help me by letting me know if there's any problems. Let's now take a few minutes to finish up the December options for the stock OFRP. This time I put the data on a single page, making it easier for you to see. I don't have every bit of information that I had before. I believe some of it becomes unnecessary as you get more experience looking at this data. The December 50 call is in the money with an intrinsic value. That intrinsic value is still $7 because the stock price is $7 higher than the strike price. But I want to emphasize that the time premium, $9.80 minus $7 or $280, is the maximum value. Again, when you sell an option that has intrinsic value, the maximum gain is that time value. And when I say sell an option, I am referring to this strategy, covered call writing. If you sell an option naked, and just sell it, which I hope you won't do, you'd have a chance to make every last penny of the premium because this option could possibly go to zero. But when I'm talking about a maximum gain of $280, we are talking about covered call writing. The annualized return is 9%. Not bad for the conservative investor. But you have to be willing to tie up your money for 203 days, and for that reason, I don't think very many people would be interested in writing this option. It would only be that same conservative investor, but someone who really doesn't want to take the time to be trading very often. This is not a great choice, although if the 9% appeals to you, there's nothing wrong with it. But I just don't think it would be a popular choice. The December 55 call. This gives you a chance to sell an option and get $7 worth of downside protection all the way down to 50 and a nickel, and still have a chance to earn $495 in time premium. Almost a 10% return, which annualized is 17%. Less than the 21% for September, less than the 29% for July, and less than the 33% for June. That's normal for annualized returns to decrease. I would only recommend this for someone who really wants a lot of downside protection and who wants to trade infrequently. And again, if you're a very small trader, 1 or 2 lots at a time, then there's a lot to be said for trading infrequently and saving commissions. But otherwise, most people who trade options would find the December to be too far, and September would be preferable for anyone who doesn't want to trade short-term options. I'm not telling you what to do. I'm telling you from my experience that you will probably want more action, more trading activity than going out to December. But again, full-time job, very little time. All you want to do is make some money, understand what you're doing, then the Decembers might work for you. You'll make less money, but it's less trading, less work, and more safety because you have more downside protection. Downside protection of $695. The December 60 call is all time premium. There is no intrinsic value because the option is out of the money. So your maximum gain from the time premium is $475, but if the stock moves from 57 to 60, you can gain another $300. Now it's difficult to figure out maximum return here. I don't mean difficult in that the numbers are hard to process, but where do you want to estimate your return on your investment? Do you want to assume the stock stays where it is and that you will earn $475 when it's over? Or do you want to estimate the maximum that you can earn if the stock rises above the strike price? You have to suit yourself where you determine to calculate this. I just chose the maximum because people like to see high numbers. I don't have a recommended method here. What I do suggest is that you consider the return on investment for this number, and that's referred to in the trade as return unchanged, meaning the stock is unchanged, versus return assigned. The return on investment when you are assigned an exercise notice. And if you're keeping records or any kind of a trade plan, you can have both of these numbers, return max and return unchanged. And the same for the annualized, so you can have numbers to compare, see what you're trying to earn, determine if that's enough earnings for you, and if the risk is satisfactory. When we look at the December 65 and 70 calls, we have a similar situation. I mean, similar with each other. They're both out of the monies. They both give you a decent amount of cash. It's certainly worth writing. It's not like it's $15 and has no value. The question is, if you're the long-term holder, are you willing to take the chance of losing your stock at $65 a share for this sum, for $315? Are you willing to take the chance of losing your stock at 70? And by losing, I mean selling it at 70 for $205? Did those numbers appeal to you? If they do, then these are very good options to write. This is basically you put it away and forget it, and assuming the stock doesn't take the big move, you can just do this again every 6, 8, 9 months, whatever appeals to you, even every year. Some stocks have options that expire in January, they're called leaps, of the next year. So in this case, that would be January 2012 and January 2013, but in not too far from now, the January 2014s will be issued for some stocks. They come out on a staggered schedule. So this is a look at the December options. And except for looking at the summary slides which follow, that pretty much takes care of looking at each of the options in a given stock and deciding which may be an appropriate covered call right for you. Now keep in mind, it does take experience. What I've tried to do with this discussion is pick out which type of trader would like each option. I'm assuming each of you has some idea where your comfort zone is and what type of trader you are. That's something I can't do for you unless we have a personal discussion. I don't know how we're going to have time for that. So it's really up to you to figure out where you are. And I'll help you find those guidelines as we discuss what it takes for different types of traders, different ways of thinking. Next time, we'll go into 2 more strategies. The selling of put options when they're secured by cash in the account. And what I mean by that is, if you sell a put option naked, there is the chance that you will be assigned an exercise notice, and if that happens, you have to buy the stock. If you have enough cash in your account to buy the stock, then you are cash secured, and that's okay. This is a legitimate way to sell naked options. If it's a stock you want to buy, you get to buy it at a discount. So we'll take a look at that, at how that works next time. In addition, we'll talk about collars. Collars are sort of a combination between writing covered calls and buying protection to limit losses. That's a very conservative strategy. You may not want to do it, but the reason that it's important to understand is that it's very much connected to a string of other strategies. And those other strategies are going to be of great interest to you. So I want to give you the foundation for going from one to the other. When talking about risk, as I have in discussing reward versus risk for a given trade, I've never given you a way to measure risk or determine exactly what risk means. Let me tell you there's two ways to define risk. The less important way, and the way I don't like to refer to it, is the probability of loss. If a trade is going to win 80% of the time and lose 20% of the time, it has a probability of loss of 20%. Yes, that's a good definition of risk, but it's not what we focus on here. When I talk about risk, I'm talking about dollars at risk. In other words, in the worst case scenario, how much can be lost? Or when you plan your trade, do you have an exit point, a stop loss point at which you will limit losses? That's the kind of risk we're talking about, dollars at risk. Now, when writing covered calls, the best way to look at the risk is how much can you lose if the stock moves down? I'll give you more risks in a few minutes, but this is the big one. The one where you can lose significant money is if you buy stock and it falls 5, 10, 20 points, keeps going down. That's where you can lose a lot of money. So most traders, though not all, have a point at which they stop themselves. They have a stop loss point. They have a mental place at which, if the stock reaches that price, at which they will just exit the position, take the loss. So it's the same thing when writing covered calls. At some point, you may want to sell out your stock because it's too painful to hold, and you may choose to, and you will have to, most brokers will not allow it, buy back that call option. Because if the stock has dropped enough, the call option is going to be cheap, but you're going to have to waste some dollars, at least it's going to feel like it's wasted, to buy back that call option. So the way to measure risk when writing covered calls is how far are you going to allow the stock to drop before you exit. Now, when we discuss most other option strategies that don't involve stock, you won't have to make a decision exactly this way. It won't be a case of I own stock, I have to sell it. It will be a case of exiting a trade. And we'll talk about each type of risk management for each trade as we get there. But the generic picture of risk management is cut losses. Cut losses before they become large. The other way, major way, to manage risk is to determine position size. If you buy in a covered call right 200 shares, well, your risk is going to be a lot less than if you buy 1,000 shares. But of course, so is your profit potential less. So you have to look at the position, determine the correct position size. How much are you willing to risk? How much are you willing to risk in your worst case scenario? And of course, the stock could issue bad news and wind up bankrupt the next day. But ignoring that possibility, how much are you willing to allow the stock to go down before you exit your position? That'll give you an idea of how much you can lose per trade, per spread, and then you can decide just how many shares of stock to buy to limit your losses. So when we talk about risk, we're talking about dollars at risk, okay? Now, let's examine the other risks associated with writing covered calls. The largest risk is, as I just said, when the stock makes a big move down. The second risk, in my opinion, is not really a risk at all. It's actually a good thing and not a bad thing. But some people look at this as a risk. And I'm talking about the situation in which you buy a stock and sell a covered call at this strike price, and the stock just zooms up past, much higher than the strike price. Your profits are capped here. If you remember that graph, it looks like this, where you have ever-rising profits, but it levels out at a certain point. Well, once you get beyond the strike price, you can no longer profit from this trade because you have sold all profits above that strike price to somebody else. That's what they bought when they bought your call option. So if the stock runs way, way up, you didn't make all the way up here. Your earnings were capped at whatever strike price you sold the call option. Now, to me, that's a good thing. At the time you decided to sell the call option, you had a price target in mind or a profit target in mind for the spread. And if you make that amount, well, then you've made the maximum possible profit for this spread. That's a good result. If it could have been a better result, if you had adopted a different strategy, that's just pie in the sky. You cannot expect to get the best result on every trade. You may not ever get the best result on any trade. That's not important. Your goal is to make certain amounts of money if you're going to be using options in limited risk, limited reward strategies, which are the kind that I propose that you use, rather than unlimited gains and losses, which are too risky. So if the stock runs beyond, to me, that's a good thing and not a risk. Another risk of writing covered calls. If your plan is to sell stock, if that's the most important aspect of the trade, for example, you own 300 shares and you want to sell it at $55 per share. If your most important aspect is to sell that stock at 55, you have two choices. Choice one is to put it in order with your broker, good till canceled, sell 300 shares at 55. If and when it gets there, you'll make the sale. If it never gets there, you won't make the sale. That's choice one. That's the simple choice. Choice number two is to use covered call options, write covered call options. For example, if you sell the right to buy your stock at 55 to someone, and let's say you collect $200 in premium. If that stock runs to 55, 57, 58, you would have sold it had you had a good till cancel order in with your broker. But because you have stock, because you sold the 55 call, you cannot sell the stock when it gets past 55, or else you would be naked short this call, subject to a big loss if the stock rallies still higher. So you're locked into the position, and you hold it. And if the stock runs down below the strike price, and expiration arrives and the stock is 54, 53, some price below 55, the calls will not be exercised. The option owner will not buy your shares, and you'll still own your stock, and you will not have sold it even though it traded beyond your price. The good news is you have $200 cash in your pocket, so you no longer have to sell it at 55 to reach your target profit. You can sell it at 53 and be just as happy. Now, when I said earlier that you were locked into your position, that didn't mean that you can't exit. But if you sell your stock at 48 and wind up buying back your call, you will wind up paying more than $3 for the call. And when you buy the call and sell the stock, you will not net $55. You will net less than $55 per share. So if the stock moves up and goes past 55, and you want to buy back your call option to close the position and sell your stock to close the position, the fact of the matter is the call is going to cost enough that you will not be able to buy the call and sell the stock and net $5,500 for each covered call position. You will have to accept less. Now, that may be good enough for you. After all, you did get $200 to start, so if you can get more than $5,300 now to exit, then you are achieving your $5,500 price. So that may work for you. But the point is, if the stock runs up and runs down and you haven't exited, then you will have lost your opportunity to sell the shares. That's what I want to point out. You will have lost the opportunity to sell the shares. That's a risk because the stock might go much lower. Okay? Another risk is that you may lose the dividend. Most of the people who trade covered calls are looking to use stocks that don't pay large dividends. The reason for that is those are steady, non-volatile stocks, and the option premiums tend not to be high, so there's not a lot of reward in selling them. But if you're someone who uses dividend stocks, if the stock runs high enough, and if the dividend is large enough, someone may exercise the call the day before the stock goes ex-dividend. That means you will be assigned an exercise notice as of the day before, as of the day they exercised it, which is the day before the stock goes ex-dividend. You will not own the stock on ex-dividend date, and you will not collect the dividend. So if you're counting on collecting the dividend, one of the problems with writing covered calls is the possibility of not collecting that dividend. And it can come as a surprise. If you have a stock that you buy at 31 and you sell somebody the 35 call and the stock runs to 39, the call owner may choose to exercise that call option, which is in the money by 4 points, to collect the dividend. Now, there's more to discuss on that, and I will talk about exercising for the dividend, but it's more advanced. We'll save it. It won't always happen. The option owner won't always want to exercise. That option owner has to worry about his or her risk about taking the stock just for the purpose of collecting the dividend, but it may happen, and so that's another risk. So covered call writing has several risks associated with it, but the only one that's really significant, the only one that's really big, is that the stock could tumble and you could lose a lot of dollars. So this is the beginning of risk management. One strategy, one method of risk, of what can happen to you, what goes wrong, and we would want to talk about what you can do to limit risk and how you would manage your position so that the risk of a big loss can be minimized. And we have ways to do that. Right now, however, there's more than one way to run an options education class. One is to finish covered call writing and talk about everything there is to talk about. Or I can discuss a couple of other strategies, tie them together, and discuss risk management as a package. I'd rather do that. So we'll look at specific ways to manage risk for writing covered calls after we've talked about a couple of other strategies. The point of what we're doing by concentrating so much on a single strategy is that we want to see how strategies are related to others. For example, this strategy is very close to another strategy. And then we'll take a third strategy that's very close to other strategies that you will want to trade. And when I say very close, I'm really exaggerating. They're actually essentially identical. But we have to take our time before we get there. I want to show you why these strategies are identical and why you may want to use the one we're going to talk about later rather than the one that we're talking about now. But we're starting here with writing covered calls. And then we'll be talking about selling puts, and then we'll be talking about collars, because those are easy to understand. We'll start and move gradually through the education system, and then we'll look at more complex strategies and tie them all together and look at risk management. And although that may sound complex, if you understand each step as we go along, it shouldn't be. So looking forward to next time when we will get into naked put selling and collars. And of course, you don't have to wait. You can watch that video right now. But until then, I wish you good trading.